Hi, this is Hugh Wang with the Home Loan Source. So today's question is, what is the loan refinance process, and at what point can I switch lenders or not proceed with the loan? So I'm going to start off with one. So initially, you're probably going to be in touch with a mortgage, a loan officer. They're going to ask you some questions. They're going to take down what's called a loan application, a 1003, and then from there, if everything looks good, they prepare the initial disclosures. And the initial disclosures, you either e-sign with, you'll probably get an email sent to your email mailbox, and then you can do e-signature, or you can wet sign. At this point, they should have locked in the interest rate already. Usually the locks are for 30 days. So remember to keep in mind that locks, even though they're for 30 days, but out of a month, you have 2 weekends, so Saturday and Sunday, and banks usually don't work. So out of 30 days, so you take out 8, so you really have 22 days. So if your loan officer asks for certain documents, be sure to send that over to them right away, because time is of the essence. Now at this point right here, you're just signing the initial disclosures. So if the disclosures aren't what you're getting at this point, you can call your loan officer and tell them either give you the deal that you guys discuss, or you can actually back out of the application at this point. Okay, so the next one is, once the disclosures have been signed and you've sent in all your documents, then they submit it in for loan approval. So that's called loan submission. So they'll compile everything together, open up title and escrow, and they'll put it into a PDF package and upload it to the lender. And then it should have been locked in for 30 days. What you want to do is you want to ask them for a lock confirmation, so that way you know when your lock's expiring. And that your lock is locked in and you're good for a certain amount of days. Because when the lock does expire, it does cost more money to extend the lock. Okay. Then the next one is the loan officer is going to order the appraisal, and that takes about 1 to 7 business days for the entire process to complete. So the loan officer places the order, and then the AMC, the appraisal management company, processes the order, finds the appraiser, then the appraiser has to contact the client. The client has to talk to the appraiser and then schedule an appointment. They go out there and make sure that you guys have smoke detectors and carbon monoxides installed, because if you guys don't have it, and the water heater being double strapped, because if you don't have it, then they're going to put it in the report, and then they need to go back out there, and that's going to cost another $150. Okay, so make sure that smoke detectors in every room and a carbon monoxide detector, 1 on each level, and the water heater double strap, because that's what the appraisers are looking for. So now you've ordered the appraisal, you schedule the inspection. At this point right here, I mean, if you already paid for the appraisal, you can still cancel it before they go out there. But once they go out there and you decide to cancel the appraisal, then they're going to charge you. If they go out there but they don't do the inspection, they're going to charge you a trip fee, which is probably like $150. So at this point, you're probably if you cancel here, like say they didn't lock in the interest rate, the rates went up, then you're probably going to lose some money. And once they do the inspection, well, then it's non-refundable. Okay, and then 4 is the approval. So now that the underwriter has reviewed the entire package from the loan submission, she's going to send to the loan officer prior to a PTD approval, which is a conditional approval with conditions. So they might be asking for either updated pay stubs, clarification on the pay stubs, maybe a verification of employment, maybe overtime income, commission income. They might have questions on that. A lot of loans get denied because of income. So at this point right here, they might give you a conditional approval. However, you might not be able to satisfy the conditions. So make sure you review the condition with the loan officer. And then you're going to start to send in the documents. So make sure you send the documents right away. And after you send the documents, make sure the loan officer reviews the document, because a lot of times the documents are illegible or they're not the right documents. And then that's why you have to keep sending over documents. And then the appraiser comes in. What they're looking for is the value, and they're looking for is it as is or is it subject to? Because if the appraiser goes out there and you're making repairs, then they're going to make it completion too. So then you have to complete it before the underwriter accepts the appraisal. And then if the value is in, and it is marked as is. You don't need to go back out there. He doesn't need to go back out there. And then, so now you're going to satisfy. They're going to review the appraisal. The appraisal review team is going to review it, and then they're going to clear that up. So now the appraisal is done. Then you have the prior to doc conditions. Now, I hope if everything goes well, all the prior to doc conditions are all satisfied, and they're going to draft up loan documents. Now, at this point right here, so signing the loan documents, these ones right, you cannot e-sign those. You have to sign it with the notary. And at this point right here, the loan is pretty much almost done, but you can still back out if the deal is not right. So make sure to go over the loan documents with the loan officer. And if you have any questions at any of these points right here, if you consult with another loan officer and tell them your situation, and then they can tell you if it's right or if it's wrong, if they're, maybe the loan officer is not telling you the full details, okay? So then the notary goes out to your house, or you go to the escrow company to sign loan documents. This is probably about 100 pages. And then what happens is, so the docs go back to the lender, they satisfy the funding conditions. Funding conditions just depends, maybe the pay stubs are outdated, or they might have some prelim, some title paperwork that they need to fix, like maybe the proposed CPL, insured, maybe the insurance declaration page needs to be updated. And then what's going to happen is once they satisfy that, they're going to fund the loan, which means that the lender is going to wire the money over to escrow and or actually to title, and title is the one that's going to be paying off your mortgage. And then the next day, if you're in Orange County, it records the same day. But if you're in LA County, Riverside County, San Bernardino County, it's going to record the next day. And when it records, loan escrow closes, and that's when they do the disbursement. So if you have debts that are being paid off, the escrow company is going to be sending out the disbursement. And if you have a refund due to you, then the escrow company is going to send that to you as well. And typically, if you close, say, July 31st, you're going to skip August, and your first payment won't be until you're going to skip, so if July 31st, you're going to skip August, and your first payment will be September. Okay, so if you have any questions, you can reach me at 714-352-0808. Again, 714-352-0808. Or you could visit, for this article, you could visit thls1.com. And you can send us an email if you want a free consultation. Thank you for watching, and have a great day. Bye-bye.